Economics for Business, a economics course developed for business students with an alignment of CFA Level 1 economics learning outcomes. My name is Jamil Shaya. I have a PhD in economics of financial institutions and markets. I have an undergraduate degree in economics and a master's degree in economic development. I have actually completed the CFA exam level 1, so I'm familiar with the material and the evaluation. But let me just emphasize here that the course itself is developed as an entire semester's worth of macroeconomics with an emphasis for business students, which is also aligns with the CFA curriculum. So this course benefits both business students and CFA level 1 candidates, and I hope that this course will be beneficial for you. The learning outcomes, you can find them at this link that I posted here in blue. And I've put the learning outcomes at the beginning of every video to know exactly what we're going to focus on. In this video, seeing as still an introduction, we want to cover the first learning outcome, which is calculate and explain gross domestic product using expenditures and income approaches. In general terms, we're looking at the broadest measure of what an economy is. Like if you're talking about a car, you're going to think about, okay, how many horsepower does this car have? Or if you're talking about a house, how many square feet does it have? Well, when you're talking about an economy, you want to talk about how big that economy is. Well, that's GDP. So what is GDP and how do you measure it? And you're going to see that there's a lot of different ways of measuring an economy. So let's get familiar with an economy. What is an economy? Well, an economy is the aggregation, the sum of all interaction between economic agents. So in layman's terms, when you go to the store and you want to buy a chocolate bar, well, there's a transaction there. And when the store bought the chocolate bar from the company, there's a transaction there. When the company bought the chocolate, the cocoa from a producer, et cetera, well, all of those series of transactions must make up the entire economy. And if we do that a million times, well, that's our economy. So how do you figure out how to add all of those things up together? The other broad questions that we will cover eventually are ideas of comparative advantage. How do some countries produce some things and not others? How many people have jobs in an economy? How productive are those people? What are the general price levels in an economy? When we talk about inflation and deflation and things like that. And what are the actions of governments in terms of budgets and deficits and debt? And what are the actions of central banks in terms of interest rates, open market operations, quantitative easing, interest rates in general? So GDP being the broadest measure, and it kind of helps us navigate all the other important questions in economics. So the GDP will help us situate us in the business cycle, which we need to go into a lot of detail because as a business student or a student of finance, the business cycle actually helps us identify where we are in order to know where we're going, to know what kind of investments we should be focusing on, what kind of economic activity might fall in favor or fall out of favor. So what are the factors of production? Because in order to get to this kind of GDP, this level of production in an economy, we have to know how do we make stuff. Well, the things that make stuff in the simplest terms are land, labor, physical, and monetary capital. So physical capital, think of a machine. Monetary capital, think of money and other assets, financial assets. Labor is the work that you put in, and land is land, right? So in any mix of those four factors of production, we should be able to produce output. And therefore, output is the output of the factors of production. Now, another way of thinking about the economy is not in terms of output, but is in terms of income. Because if I say I made, a table and I sold it off, I could say that I made this table, this is my output, or I could say that I sold this table and made, $100. Well, that $100 income is equal to the output that I made. Therefore, we're at our first concept, which is there's something called aggregate output and there's something called aggregate income, and they should be equal to each other. We need to know that because we want to measure the size of the economy. So there's now two ways of measuring the size of the economy. And another way of putting it, if I think about my wallet, there's the money going into my wallet and there's the money going out, and they should, at the end of the month, they should be equal. So what are the forms of income that we know of? Well, the broadest form of income is the compensation for labor. So most people in any economy are actually employees, and they get paid in forms of compensation, salaries. The other forms of income are rent from land or property, and the rent from machineries or cars or things like that, physical capital. Interest is essentially the rent of monetary capital, and profits are the corporate net surplus of capital. So if a company buys a machine and then it borrows money and then it sells stocks or issues stocks to investors, well, whatever's left over at the end of the day must be the surplus of the factors of production. So if I add all of those forms of income together, I need to get the size of the national income. And at the beginning I said that the economy is the interaction between economic agents. Those economic agents are households, so you and your family make up a household, a firm, which is a company, the government, and the rest of the world. This is how we see the world in economics. So there's households, there's people like you and me. There are the firms that own businesses and make decisions based on how much to produce, how much to sell at, how to invest, how to buy new machineries and expand to another country. And there's the rest of the world, which are other economies, other households and other firms, and how they interact with us. So the households, at the end of the day, are actually the final recipients of all income, if you think about it, because who owns the firms? Well, it's essentially households. Who makes investments in firms, and who rents out physical labor, and who rents out labor, and who rents out physical capital, and who rents out money, etc., etc. Those are households. So the final recipient of profits are households, except for the retained earnings, which stay within companies. And that's going to be a little bit important after, because we're going to see that when we add everything up, there's a little bit missing. And sometimes we make something in a country, but we don't buy it in the country. So let's say I made this table that I was talking about before, but I sold it to another country. Well, the consumption of the household in the other country, the expenditure, it doesn't add up to what I made in this country. Therefore, there is some kind of accounting that I need to do with respect to other countries. That's all going to become clearer when we have the formula in front of us. So in the simplest world, imagine a world with no government, no saving, and no rest of the world, no other economies to deal with. Well, there are households which are buying goods and services from firms, which is the green arrow here. And there are firms which require land, labor, and capital from households in order to make stuff. So I'm going to go to the household and ask them, do you want to work at my company for this salary? That's labor. And land means that, you have a land and you rent it out to a company to build a warehouse. That's land. And the other forms of capital, monetary and fiscal, is essentially households or firms indirectly that essentially own them, right? In the simple world of ours. And in exchange, the household gets wages, profits, rents, and interest. We said all the forms of income. And in exchange, once the households get money, well, they go buy stuff from the firms. So this is our simple economy. That's it for this video. The next video, we will talk about learning outcomes B and C. We saw that the broadest definition or characteristic of an economy was the GDP. That's how we characterize the economy. And to do so, we said there are two ways of measuring GDP. The first one was expenditure, and the second was income, and they should be equal. And now we want to see, how do we actually even get there? We want to add these, each individual component, each individual transaction, in such a way to get the total GDP in the country. So there are two ways of doing that. The sum of value added and the value of final output. And very simply, if I have an orange juice, Do I take the final value of the orange juice, which is, let's say, $1, or do I take the value added of each step of the way? So in the simplest way possible, the orange juice, when I buy the final product, let's say it's worth $1, that dollar, inside of it, there's a few steps, there's a few transactions to get there. Well, there's the supplier who sold the oranges to the man who makes the juice. And then when he purchased those inputs, the oranges, and then transformed them to make the orange juice and sold it to you, well, let's say he bought the oranges for 50 cents per orange juice, and then he sold it for $1. Well, he added an extra 50 cents of value to get the final price of $1. So both ways are going to get us to the same answer, but one has a little bit more information than the other. The final price is just the final price, so there's no information there besides the price of the final good. But the sum of value added, I'm going to take each step of the way in the production process and find out how much each step has added value to the final price. So in terms of information, the sum of value added is much more informative than the value of final product, but in the end, they get us to the same answer, which is the final price. Now, based on that idea, how do we measure either the final price or the value added methodology? Well, there are some principles in the measurement. The first one is that the income and expenditure must equate, and I will only measure the value of final goods, so the orange juice, or the steps along the way. The measurement of GDP needs to be time specific, so within this date and this date, it's a flow measure, so all the economic activity that happened during a period. And finally, the price has to be market determined. It can't be just set. For example, if I make a cake at home and I give it to my family, that cake, the production of that cake and the provision of that good is not provided by the market, so there's no market price for that good, then I don't add it. So based on that, the measurement is only of final goods within a specific time period, and it has to be determined by the market. We said it could be the sum of value added or the value of final output. There is a more complicated concept in measurement, which are imputations. Imputations are things that are not directly measured, but are imputed from something. So the most important imputation that usually happens is owner-occupied rent. The idea is that if I buy a house next year, so in that year I'm going to measure the production of the house in GDP, but in the years after that, I am benefiting from my house. And that benefit needs to be imputed into GDP in order to account for its value. And that's called owner-occupied rent. So if I were renting this house, how much would I be paying? That value is going to go towards GDP because I am using that service of the house in that year. That's what the imputation is about. Now, there's a lot of argument whether or not that's valid or not, but that is the standard when measuring GDP, so owner-occupied rent. The other things that are some government services that are also imputed, for example, the value of a fire, the fire service, the firemen that protect our cities and our houses and our apartments and our forests, well, their service is not market determined and there's no value for that service. So how do you put that into GDP? Because they're obviously providing some service, which is extremely valuable. And therefore, the easiest way to do so is just value it at cost, their salaries, the cost of the machinery and the fire hydrants and stuff like that, the trucks. So that's another form of imputation that needs to be accounted for when measuring GDP. Now, for us, that's not going to be very important. We'll leave that to the statisticians and the people that deal with national accounts when they measure those things. But you need to be aware that there's a very big part of GDP which is imputed and not directly observed in the market. Besides that, there's other problems with GDP, which are the parallel economies. And I call them parallel because there are different stages. There's illegal activity, which does not get counted towards GDP. There's the underground activity, which is not necessarily illegal, but is not registered. There's under the table as well. It could be legal activity, but illegally administered. So, paying to avoid taxes and things like that. And there's the informal sector, which is like me making a cake at home and giving it to my family. Well, that is I obviously produce something, but it is not formally transacted into a market, and therefore it is an informal market. So there are some economies that have very large parallel markets. Some parallel markets are estimated to be upwards of 60% of the entire economy. And that is going to change the way we perceive the measurement of GDP, knowing that there's a huge parallel market associated to it. The next concept is that when I do measure GDP, and GDP is the sum of all the final products within a time period determined by the market. So let's say I have my orange juice, which is $1, and that's for 1 cup of orange juice. Well, next year I'm going to make that same orange juice, but now the price of that orange juice went up. Now it's $2. If I look at my economy this year, which is $1, and the economy next year, which is $2, did my economy actually get bigger? Well, no, it didn't, because I still produced that 1 orange juice. Therefore, there is some concept which is real and nominal. Real would be the 1 orange juice that I made this year and the 1 orange juice that I made next year. The nominal value is the dollar price in that year. So the $1 of orange juice and the $2 of orange juice in the following year. I obviously don't care about nominal. I should really care about real, because what I want to see is how much did the economy get bigger by, and that's how many more orange juices did I make, not the value of those orange juices. The second thing I want to look at, a measure that most economists will look at, is the GDP per capita, because what you'll notice is that people say, Chinese economy is huge. It is. But if you look at how big that economy is with respect to how many people are there, you'll notice that it's actually not that big with respect to how many people live there. In the States, there's a lot less people, but the economy is bigger, and therefore what you can actually think of is that the average American is more productive than the average Chinese. Even though the size of the economies are similar, the output per person is very different. And that's what we really want to care about, looking at GDP, so GDP per person. There's other more specific measures, and we will get to those eventually. So how do we measure GDP? The first one, the nominal GDP over here, is the sum of all the products. So I said I to N, which just means orange juice plus bicycles plus cars plus houses plus everything. Those are all the products that I have. I'm going to see how many of them did I make. So this is my orange juice over here, and times the price of that orange juice in a given year. And if I add all of those things together, I get nominal GDP. Real GDP, the more important measure, is the same formula with all the products in my economy times the quantity I've made of all of those products. But here is the difference. It's the base. What that means is that I'm going to keep the price fixed. I'm not going to change it. So let's say in my example earlier, that 1 orange juice that I made in a year was $1. So $1 times 1 orange juice equals 1. That's my nominal GDP of that year. In the subsequent year, I have one orange juice, but now it's $2. So 1 times 2 is $2. My nominal GDP in that year is $2. But if I kept the price at the base year, so let's say my base year is the first year, where the price of the orange juice was $1. In the next year, if I kept the price fixed, I would say I would still have my 1 orange juice, and it would still cost $1, and therefore the real GDP would show us that the economy is still $1, and there was no growth in my economy. The deflator is the ratio of the nominal GDP divided by the real GDP, and in that sense, when you think about it, what it's actually measuring is the difference between the P's. So it's some kind of indication of inflation, inflation being the change of price in the economy. And deflator is the broadest definition of inflation. And we're going to see that that's not always the measure of inflation that we use. So remember, the formula is very straightforward. Nominal GDP divided by real GDP is the deflator. And we can do the same measures per capita, and the difference is that I would just take nominal divided by capita, real divided by capita, etc., etc. So let's do this simple example where I have, I called it A, but we can call this orange juice, and I can call B, cars, for example. And my prices, as you can see in 2019, are $1 and $2 respectively. In 2020, the price of orange juice went up by 50 cents, and the price of cars, or whatever it is, went down by 50 cents. And the quantity also changed. For oranges, they stayed constant, but for cars, it went up. So how do I use this formula? Let's do nominal GDP for 2019. I'm going to take the Q times P. So Q is 100 times $1 plus 100 times $2. And in 2019, my GDP is $300. Right? You notice that GDP is just a dollar value. We're not talking in terms of oranges. We're talking in terms of dollars. Nominal GDP in 2020 is the same idea, Q times P plus Q times P. So we're going to get 100 times 1.5 plus 150 times 1.5. And I get 150 plus 225, 375. Okay, now what happens if I do real GDP in 2019? I always have to use the price of the base. So let me decide that 2019 is my base. I'm going to use the same formulas, but I'm always going to use these prices and I'm going to ignore these ones. And in 2019, it's going to be 100 times 1 plus 100 times 2. I still get 300, right? Because the base of 2019 is the same, so I'll get the same answer. But real GDP in 2020, let me erase this. Remember, I'm going to ignore this. I'm going to do real GDP in 2020. And I'm going to take the quantity of 2020, but I'm going to take the price of the base. So I'm going to take 100 times 1 plus 150 times 2. I get 100, 300, I get 400. My real GDP in 2020. And to get the deflator, I would just take nominal divided by real times 100, and I would get some kind of measure like we said nominal GDP in 2020 was 375, and the GDP deflator is equal to nominal divided by real times 100, and that would be my GDP deflator. Let's see what we're going to do next video. That's it for this video, just very straightforward. Next video, we're going to compare GDP measures, and we're going to explain what relationship between all of these variables that we're going to develop with each other. Welcome to the third video. In the first two videos, we talked about GDP more generally. We said that once we added up all of the things that were produced in an economy, we use the example of orange juice. If we add all of those orange juices together, we should be able to get the size of the GDP or size of the economy. And once we have those orange juices, we can figure out how to measure them in terms of how many people bought those orange juice in terms of expenditure, or how much money the man who sold the orange juice made, right? So that's the income approach and the expenditure approach. And we used either the value added of the oranges that made the orange juice, or we just used the final price of the orange juice to measure GDP. Then we said that, well, if I want to measure GDP from year to year, well, then I have a problem of what happens when prices are changing. And we said that we could always take a base year in terms of prices and figure out how much quantity actually changed by instead of quantity and prices to get a clear idea of how much stuff was produced in the economy. Well, once I got the GDP in the country, I want to figure out how to get GDP and national income and derive something called personal income and disposable income, and then really get to the point of what macroeconomics is for business students and for finance students, is to figure out how does this affect saving and investments, the fiscal balance, and the trade balance. Those are our learning outcomes for this video. So first things first, this is the first kind of model that we're going to develop to understand how the economy works. And this is going to be the expenditure approach to understanding the economy in terms of GDP. So what are the components of GDP? Well, I said that there are 4 actors in our economy, 4 basic actors, and those are the green icons. So we have here, underlined, is the household. On the right, we have the firms, companies that make things. The globe is the rest of the world, and the institution here is the government. So let's talk about each one by one. And so my GDP is the sum of the consumption by households, the investment made by firms, the spending made by governments, and how much is exported and imported with the rest of the world. So those are the 4 broadest sectors. Okay, I always use the word broad because we're still at the surface of the economy before we can go into more detail. Those 4 sectors interact in 3 primary markets. Those markets are going to be the things in the middle. So factors of production here, the market for the factors of production, land, labor, and capital. The goods and service market here in the middle, and the financial market there at the bottom. So these 4 sectors all interact with each other in those 3 broad markets. Consumption, let me clear these markings, these elements, these interactions. When the household buys something from the goods and service market, there are different types of consumption. And we care about these in terms of business students. So listen to this. Consumption can be either in durable goods, so think about cars and fridges. Non-durable goods, think about food and clothes. And services, think about haircuts. This is going to be a very important distinction. If we can measure these, and we do, if we can figure out how much of consumption is in durables, non-durables, and services, we can identify where we are in the business cycle and where we're going to figure out what sectors of the economy, what industries are going to be doing well or bad in the foreseeable future. A very important skill to have in business or in finance. Investments, which is not the same thing as financial investment, and this is something we have to emphasize very strongly here in economics. Investment in finance is when you buy a stock or a bond or something like that. But investment in economics is investment in capital, or in general, investment in something that helps you make something else. Capital expenditure. Okay, so investment in economics is investment in something that makes you something else. In our example here, the investments, think about, buying a machine or some land or something like that. The government can also do something similar to that. The government can spend money in terms of consumption, so I call that GC, and the government can spend money in terms of investment, so think about a highway. And now, all of these actors in those sectors are going to interact with each other. And you guys know them all, but this is the first time that you might have seen them in a diagram of some sorts. The household is going to consume from the goods and service market, which is provided by the firms. And the firms also need to invest in or buy stuff from the goods and service market in order to make more stuff. So the firms are actually the ones who produce all of the things that are going to be consumed, invested, bought by the government or the rest of the world, which is what that thick line is there for. The government purchases, called government spending, things from the goods and service market, and the rest of the world will export and import from us within the goods and service market. So those things I think should be clear, and this is what the GDP measure here is. And the interactions are can be broader than that. So those are specific interactions, those are direct interactions. The households also have to pay taxes to the government. The households also can save money, which goes into the financial markets, right? Your deposits or your investments, your retirement funds, things like that. Those go into the financial market. And firms, usually if they want to do some kind of investment, they can go to the financial market in order to issue stocks or issue bonds to borrow. And they get those money from the financial markets. Essentially, when you think about it in broad terms, is actually the household who provided that capital, that financial capital, for the financial market to channel that money towards the most productive firms. And finally, the households provide labor, which generates income for them. They can rent out land and property, and they can own the firms, and they provide those factors of production for the firms to purchase or to acquire or to rent or whatever it is, the land, labor, and capital required to produce the consumption, investment, government spending, and net exports. Now, national income. This first part was expenditure, I said. The second part is income. It's also going to be some kind of model that should be equal to each other. So what is income? Income, we said in one of the first videos, that income is the sum of the compensation of employees, and we said most people in an economy are employees. Proprietor income, so if you own a business, the business is yours and it's in your name, and the income generated from that business is called proprietor income. Rental income, so if you owned, let's say, a property or a warehouse and you rented it out, it's rental income. Corporate profits, if your business is incorporated, not in your name, so the company is its own legal entity and that company makes profit, it's called corporate profits. Net interest is the interest earned from financial capital. If you rented out money, it's called debt. And a business can be a net borrower or a net lender, depending on how it decides to position itself, and individuals as well. And the government makes money from taxes, and it gives money to people that need it in forms of redistribution or welfare or things like that. So the national income is the government also makes money, and that's going to be indirect taxes minus subsidies. So the money that it makes minus the money that it spends, essentially. Net business transfers. So some companies will transfer money within the organization, to other subsidiaries or other branches or things like that, or to other organizations. A transfer, by definition, is I give you money not in exchange for something. A transaction, I give you money and you give me something in return. That's called a transaction. A transfer is I give you money and I didn't get anything in return. And finally, the surplus of government enterprises. So think of a government-owned casino that makes money. Well, that money goes towards the category surplus of government enterprises. Well, if I measure GDP using these components, so add them all up together, I get national income. And if I get GDP using this model, C plus I plus G plus NX, I get national expenditure, GDP. So I should be able to go from one to the other. And I'm going to do that by going from gross national product is equal to GDP. So GDP I got from C plus I plus G plus NX from the slide before, plus net factor income from the rest of the world. So remember here I said this little globe, well, I'm exporting to it and I'm importing from it. Therefore, there are some things that I need to send back to them which do not belong to me, and they need to send me things that do not belong to them. And that's why I'm going to use net factor income to the rest of the world in addition to GDP. So just think about a company that is operating in a different country, that made money in a different country, and we need to include that in income because it is a company of that nationality. So think of an American company abroad. Well, that American company is an American national, therefore it's included in the American national product. And the opposite is true too. If there's a foreign company working within the States, well, that company needs to repatriate its income to the other country. So just think about that's the factor income, because the factors of production belong to another country, belong to another economy. And then finally, GNP minus depreciation is net national product, so net of depreciation. We have factors of production that do depreciate, and therefore we need to account for those. And net national product minus some statistical discrepancy. A statistical discrepancy means that there are some measurements that we cannot account for, or there are gaps in our measurement, and that is how we're going to get to national income. So from GDP to national income, we added net factor income, we removed depreciation, and we removed statistical discrepancy, and we got to national income. So from the beginning I told you that they should be equal, but there's a small difference. Well, that's the small differences. Those are the small differences. Why is that so important? Once we got this idea that GDP is aggregate expenditure, is C plus I plus G plus net exports, and they should be equal to income. And I keep saying they should be because sometimes they're not. And when they're not, there's something interesting that happens. So let's say they are equal for now. And we're going to call, I left some black space here so I can draw it. I'm going to call national income Y. And national income, you can think about it, or think about it personally, for you as an individual. Your income is either spent, C, or saved, and you had to pay part of it as tax. So if I add C plus S plus T, that is all of your income, or if you think about it as a whole country, is the national income. And national expenditure, I said the money that you spent, aggregate expenditure here, is all the money that I spent, all the money that the country invested, all the money that the government spent, and all of the exports and imports. That's equal to aggregate expenditure. And when they're equal to each other, Y should be equal to GDP, right? Income should be equal to expenditure. And I can rewrite it as C plus S plus T equals C plus I plus G plus exports minus imports. And C goes away, and I can put this on the other side, so I get S minus I, and I can get this relationship. And this relationship is going to be fundamentally important for us. Why is it fundamentally important? Because maybe you realized so far that these things in parentheses are something that we recognize. And let's start with the easiest one. If a country exports more than it imports, we say that it is a net exporter, or it has a trade surplus. And therefore, export and import is actually the trade balance. And that's something we hear about a lot in the news. So export minus import is our trade balance. G minus T is something else that we should recognize. If the government spends G and the government earns T in forms of taxes, therefore if it spends more than it earns, this is called a government fiscal deficit. And it's a deficit because the number is negative in this case. If G is bigger than T, the number is positive, but it means it's in a deficit. So we're going to call it government fiscal deficit. Fiscal has everything to do with the government. So we got a trade balance and our government fiscal deficit. And here we have the net saving of a country. So think about this. If S is bigger than I, people are saving more than companies are investing. And therefore, we have extra saving. And that extra saving has to go somewhere. And it has to go either into the government fiscal deficit or the trade balance. So the idea is that net savings need to be, if it's positive, if it's a positive number, it has to go towards financing the fiscal deficit, or financing a trade surplus. And therefore, you can also say it the other way around. Any of these deficits or surpluses need to be financed by one of the other. Okay, in the next video, sorry, that's enough for this one. In the next video, we're going to put all of these things together in what we call the ISLM curves, the investment saving and liquidity money theories. They're models that are going to put these elements together. So stay tuned. In this video, we're going to explain learning outcome F, which explains and models the economy using the ISLM curves. But before we get to the IS curve, I need to give you some base on the aggregate expenditure curve in order to get an understanding of the mechanics of the IS curve. So to do that, I'm going to use my notepad here and go over some things that we already covered. Aggregate expenditure is C plus I plus G plus net exports. And aggregate income, let's call that aggregate income, we're going to denote as Y, and Y is equal to all the money that I spend plus all the money that I save plus taxes. And when they're equal to each other, we have an equilibrium in the goods and service market. But let's see what happens when they're not in equilibrium to get a better understanding of how we get the IS curve. Recall this curve where I have the 45-degree line, which signifies that the x-axis and the y-axis are equal to one another. I have the aggregate expenditure curve here. Let's call this AE0, and it's equal to C plus I plus G plus NX. And if any one of these variables change, well, the whole curve changes, right? But before we get there, let's say that the line intersects the 45-degree line, and at that point, aggregate expenditure and income are equal to each other. And at this point only are C plus I plus G plus net exports equal to C plus S plus T, where C and C go away, and we can rewrite it as C minus I equals G minus T plus net exports. This equilibrium, this equality, only is true at equilibrium. True at equilibrium. Okay? Now let's say hypothetically we have a change in one of these variables, in C, I, G, or NX. We're going to see what determines those changes. But let's say the AE curve shifts upwards. Now I have AE1, where one of these variables, C, I, or G, or NX, are different, and we have a shift upwards of the AE curve. Now let's see what happens. Let me get rid of this old stuff, which doesn't exist anymore. And this too doesn't exist. However, at this point, let's say the economy is still producing at this level, even though expenditure went up. So remember, expenditure went up, but the economy is still producing at the old level of Y. So what does that mean? If I look carefully, my economy is now spending, at this point, my economy is spending more than it's producing. And therefore, there has to be this excess of something. So think about it in broad terms. Remember, not just one company, but the whole economy. The whole economy is spending more than the whole economy is producing. And therefore, there has to be an adjustment. And what is this adjustment? Typically, you can think about it in a few terms, but let's say that companies are going to have to increase production in the subsequent period such that we start growing our economy until it reaches the new equilibrium, where the new Y star is equal to the new aggregate expenditure. right? So what happened here? Every time one of these variables changes, there's a new equilibrium that emerges. And one of these variables that changes in the economy is our interest rates. And as interest rates will change, aggregate expenditure will change, and a new equilibrium will emerge. So where do interest rates fall in my model? I'm going to rewrite every variable in my expenditure and income models, my equations, in terms of interest rates such that I can understand them. Aggregate expenditure is a function of consumption, and consumption is a function of income. The more money I make, the more I spend. And investments are a function of interest rates and income. So when interest rates go up, investments typically go down, right? It becomes more expensive for companies to borrow money or less attractive for them to invest. And as income levels go up, investments actually also go up. So think about this. If the economy is growing, well, the return on investment also goes up, making it more attractive for companies to invest. G is exogenous, and that's something determined by the government every year when they draft a budget. So that's why I'm going to put the bar on top to say that it's exogenous. And net exports are a function of relative prices. So I'm going to put prices domestically with respect to foreign prices, and domestic incomes with respect to foreign incomes. So this is my aggregate expenditure, and what we can see is that interest rates do play a function here, do play a role in determining my level of expenditure. And when interest rates go up, typically I expect my aggregate expenditure to go down. But we have more, because aggregate income, which we said is a function of C, which stays as a function of Y, plus savings, which is also a function of interest rates. When interest rates go up, people save more. And when incomes go up, people also save more. And taxes, realistically speaking, I'm going to put small t here, because taxes are a function of income. And we know that the larger the income, the more relative tax you pay. Therefore, tax is also a function of income. And t times y will be capital T. So in my function now, I want you to think about this, is that my aggregate expenditure function can also be thought of in terms of R, and my aggregate income can also be thought in terms of R. So what happens in my equilibrium? So only in a state of equilibrium are these two equal to one another. What happens with interest rates and income levels? So I'm going to draw another graph where R is on the y-axis and income is on the x-axis. And I want to see what happens to every stage of equilibrium as interest rates change. So going back to here, we saw that there was an old equilibrium, and when interest rates change or one of these variables change, there's a new equilibrium. So if I think about it, I say, well, interest rates are this high, R0. What happens to my equilibrium points on these curves? Well, when interest rates are high, I know that companies are not going to invest a lot and people are going to save a lot, meaning that in general, the market is going to find a state of equilibrium that is typically lower. And I'm going to put a dot here. And when interest rates go down, let's say to R1, companies are going to invest more and people are going to save less, which means that they're going to spend more, which means that my equilibrium state in the economy is going to increase. And I can keep doing that for every level of R such that I can derive a new curve called the IS curve. I repeat, every point on the IS curve is a state of equilibrium where aggregate expenditure is equal to income. It's this point here. There is no state of disequilibrium as long as that stays true, and that's why every point here on the IS curve is one of the equilibrium points. So I can almost think about it as rewriting it the way I did before, saying the IS curve is actually this equation here. Where R and I are functions of interest rates and income, G is exogenous, T is a function of income, and net exports are a function of relative prices and relative incomes. In the next video, we'll cover the liquidity money curve. We explained how the IS curve is the curve which displays the equilibrium in the goods and service market for every level of interest rate. And we didn't see how we are going to derive that interest rate, which is going to clear the goods and service market and the other market. So what is the other market? The principal second market is the financial market. And to understand that, we're going to look at the demand and supply of money, because all other financial assets are actually derived from the market for money, in the sense that all other financial assets are substitutes with respect to risk and reward relative to money. So to understand that, we need to see what money is, and to do that, we're going to look at the quantity theory of money. Erase that. Quantity theory of money. And the quantity of theory of money tells us that money, the supply of money, think about how much money is supplied in terms of physical currency, deposits, saving accounts, etc., etc. But we're going to focus on the most basic type of money, M0, hard currency, times the velocity of money must be equal to the price level in the economy times Y, the output or level of production in an economy. Think about it like this. If I have an economy with nominal GDP worth $100, either I have 100 physical dollars to move around to complete every single one of those transactions, or I have $50 and each one of those dollars is going to move twice in order to clear all the transactions in the economy. That's the velocity. So this is a transactional function of money, and this is how many times money is going to have to move through the economy. We're going to call it a velocity. And if I move things around, I could think about money as real money balances. And what real money balances is that if I have a certain amount of money in the economy, M, and a certain price level in the economy, well, that is going to be the real money balance. Think about it like this. If everything gets more expensive, I'm going to need more money in order to deal with that higher price level. And that must be equal to 1 over V times Y. And 1 over V is the amount of money I need to hold, or how many units with respect to income I want to hold in order to have enough money for my real money balances. Okay, now hold that thought, and we're going to derive another model. In this model, I'm going to talk about the real money balances in terms of demand and supply. So who is the supply of real money balances? The central bank is. They determine how much money, real money balances are in the economy. If prices go up, real balances go down. And if the prices go down, deflation, well, real balances increase. And there is a demand for real money balances. And we're going to write it like this. Real money balances, the demand for it is a liquidity function. The demand for liquidity is a function of R and Y. And if you want to write it differently, the nominal demand for money is equal to price levels times liquidity demand function times as a function of interest rates and Y. But we're going to erase the second one. We're going to keep it in terms of real money balances, the abstract idea of real purchasing power, essentially, of money. And we're going to look at this liquidity demand for money. Here, you have basically the portfolio determinant of liquidity demand, and here you have the transactional function of liquidity demand. So what makes you and I demand money? Well, it depends on the interest rates in the market. If interest rates are high, I don't want to keep cash money. I'd rather keep it in higher interest rate bearing assets like bonds or some saving accounts. And if the income level, either mine or the economy's, grows, I need more money in order to transact. That's the transactional purpose. So the demand for money looks like this. Sorry, that's not Y, that's real money balances. And now we have a relationship which determines that given a certain level of real money supply, an interest rate, a certain interest rate, R0, is going to clear this market. And if the real interest rate is different than that R0, let's say R1, well, there's going to be too much money in the economy relative to the demand for money. So think about it like this. If the interest rates are high, remember, people don't want to keep money in their accounts. They want to go use it for something more productive or higher yielding. They're not going to demand that money. So the only way to clear this excess supply is by lowering the interest rate. People are going to hold physical money instead, and we're going to eventually clear that market. Now think about this in a second way. What happens? Well, if income levels grow, the economy grew, income levels grew, salaries, whatever, things like that. Well, what happens to my function here is that it actually goes up. Because for a given level of real money balances, if my income level goes up or the economy's income level goes up, people will demand more money. And in order to clear the market with a given supply of money, interest rates have to go up. The third possibility is, well, what happens to prices, right? Because we see prices everywhere here in our model. Well, depending on the price level, well, think about this. If I tell you prices go up tomorrow, what are you going to have to do? You're going to have to hold more money, right? You need more money in order to transact over here. So your real income will change. Or you can think about it differently. In terms of this graph, if I erase these, if my P goes up, price levels go up, well, real money supply will fall. And I'm back to a similar scenario that if interest rates stay at R0, there's going to be an excess over here. What is it? It's going to be an excess demand. Excess demand. And the only way to clear that excess demand is to increase the interest rates until there's a new equilibrium. So with that in mind, I'm going to draw what is the relationship between interest rates and income. Before we saw that there was something called the IS curve, which clears the market for all, which is the interest rate that clears the market for goods and services. Well, now I know what happens to the liquidity, the quantity theory of money with respect to interest rates, and that's going to look like this. And this is called the LM curve. So for a given level of R and Y, I have an equilibrium in the liquidity preference theory of money supply, LM, and that's also going to be, this is every point of equilibrium in the money market. And this is the equilibrium at all points for the goods and service market. And when they're both equal, that tells us that there's an interest rate R, which is going to clear both the goods and service market and the money market together, and that's going to be a sweet spot. Now, we want to see what happens in both of these cases when external variables change, because in this model, in this little graph, we only have R and Y. Well, what happens when G changes, T changes, net exports, real money balances in terms of prices and inflation? Well, that's what this model is going to help us understand. So to understand the next learning outcome, the aggregate demand function, we're going to focus on prices and this model all together. Let's put everything together now. So this is going to be a little tedious, but I think when I put them all next to each other, all the graphs that we just covered, it will become more clear. So the first thing we saw was that the aggregate expenditure curve, when it was equal to the aggregate income, we had an equilibrium. And when interest rates changed, levels of investments and savings changed, and we had new levels of equilibrium for different aggregate expenditure functions. And that caused us to derive for every level of income and interest rate a curve called the IS curve. Right? When interest rates went down, companies invested more, people saved less and spent more, and income levels in the overall economy grew. That's why the IS curve is downward sloping. Then we also said that for certain interest rates, real money balances, like we drew it here, for certain interest rates and levels of income Y, that if for a higher level of income, we needed a higher level of interest to clear the market. And that's why the LM curve, clearing, the LM curve was upward sloping. And like I said, every point on the IS and LM curve are clearing points on their respective graphs. Now that we saw this, and the IS-LM curve was a clearing of the financial markets and goods and service markets, well, what happens when prices, as we see here, when prices changed? We said that if prices went up, real money balances fell, and for the same level of income, we needed higher interest rates to clear the market because people demanded more money. And for a higher level of income, or for the same level of income, if you want to think about it like this, for the same level of income, we need a higher interest rate to clear, which is why the LM curve shifts to the left. And in that sense, if now we can think that there is a relationship between income and prices using the quantity theory of money and liquidity preference for money, well, we can derive what is now known, we now derive the aggregate demand curve. And as price levels go up, income levels fell, which is why we have a downward sloping aggregate demand curve. Now, please note, like I said here, higher levels for a given level of Y, or for given levels of P, Y levels would fall as price levels went up. Now you have to note that this is not the same demand function in microeconomics, where if prices go up, demand falls. This is a different logical series. In this idea, if prices went up, people hold more money, and the only way for the banks to clear that market is to increase interest rates. And that's why the logical series is different than in microeconomics. When prices go up, things get more expensive, people buy less of it. Different mentality. And that's how we got the aggregate demand curve. So in that sense, the aggregate demand curve is actually the ISLM curve clearing, I'm going to use a different color here, this equilibrium. Every time the equilibrium changes for different P's, well, that's how you derive the aggregate demand curve. So far so good, I hope. And the aggregate supply curve is quite straightforward. So we're going to show you just upward sloping. And that is also not similar to the supply curve in microeconomics. In this case, the aggregate supply curve is the overall level of production given the overall price levels in an economy. And the curve, actually I didn't draw it very well here, looks like this. It's upward sloping with a tangency and with a flat part. So let's focus on the aggregate supply curve alone for a minute. Flat, increasing, tangency. And this tangency is Y max. This flat curve, we're going to call it under capacity or over capacity, depending on how you define it, with respect to prices. So let's think about this logically. Why does the graph look like this? Well, the tangency should be clear that no matter what price, there's a certain price or a certain level of output that regardless of the price, the economy cannot produce more than that. So it has to reach this maximum level of output. Just think about yourselves. If you guys work 24 hours a day, no matter how much more I pay you, you cannot physically work more. The only way to increase supply in that case is to increase the amount of resources, the amount of people, or the amount of technology. And if I'm down here, if I'm at the flat part, I have a lot of overcapacity in the sense that I have a lot of machinery and people that are just not working, and to increase the level of production, I only need to incentivize them a little bit by increasing the price a little bit. So if I look at it in terms of slopes, what I'm looking at is if I'm over here, then a minute change in prices would increase output by this much. So a small change in price equals a relatively larger change in output. But if I'm looking over here, in order to change Y at all, I might have to change prices a lot more in order to get the economy growing. And that means that I do not have enough capacity anymore to increase production. That's why I have to increase prices by a lot. And in that case, we can start thinking about inflationary pressure depending on where we are in the economy. So think about an economy that is working down here at the flat part. Well, increases in aggregate demand, which we'll draw in a minute, will result in large increases in output with very small inflationary pressure. Whereas if we're working at the very steep part, when we have no more capacity to grow, well, any increases in production will probably result in very large increases in prices, inflation. So when I put them together, aggregate supply, aggregate demand, 1, aggregate demand 2, and aggregate demand 3, well, depending on what aggregate demand or what intersection I'm at, if I can manage to increase aggregate demand, then the effects I'm expecting are going to be significantly different. So down here, I will benefit from larger changes in aggregate output. Small. So this is obviously bigger than this is bigger than this. And change in P, change in P, change in P, where I have the increases in price levels are going to be significantly larger over here than they would be here. So if I'm thinking about stimulating the economy through fiscal or monetary policy, I should make sure I know where I am in order to predict what kind of inflationary pressure I might induce in the economy. So if it's very clear that I'm down here, I have a lot of room to grow, then expansionary policy is something very beneficial with very little inflationary pressure. Whereas if I'm up at the steep part of the curve, an increase in government spending or stimulative monetary policy might make the economy grow, but it will definitely cause inflationary pressure, probably not worth the benefit. So in this video, we're still working on aggregate demand and aggregate supply. And we need to understand, in the previous videos, we built the aggregate demand and aggregate supply curves, but there are some nuances here when it comes to aggregate supply that we need to cover. So what are those nuances? The first thing is that aggregate supply, we said, kind of looks like this, flat at the beginning and steep at the end. But there are different types of aggregate supply. And we're going to call these, the vertical one is long run aggregate supply. The steep one, we're going to call it short run aggregate supply. And the flat one is going to be very short run aggregate supply. Okay, so very short run. Now, why does that happen? Because in reality, when you think about it, in the long run, businesses face changes in the environment, right? I mean, wages in the long run change, the prices of input. So think about the inputs like resources or cocoa for chocolate, etc. And expectations of these businesses can change. But in the long run, in this long run, physical capital is not going to change. Okay, K is physical capital. So physical capital is not going to change. In the very, very long run, of course, companies can completely transform themselves. But in the long run, in this model, companies cannot change the structure of their business. In the short run, companies face sticky wages and contracts. So think about the short run. An economic short run is not like less than 1 year, more than 1 year. It has to do with the context. And what I mean by that is, let's say I have a contract with my employer. My contract is for 3 years. During those 3 years, if there's inflation or deflation, my salary won't change, and therefore the company faces, or the employees face, sticky wages. So think about this. My salary is fixed, but the company I work for is now able to sell its product for a higher price. Well, what does that mean? That company is going to make more profit, right? Because its costs are stable and the prices that it's selling its product at went up. Therefore, in the short run, companies can increase their profits by selling more. And this is the same thing with salaries and contracts. Just think about a very large company needs to ensure that its inputs prices are stable. Maybe it signs contracts with the suppliers fixing prices for the short term. And in the very short run, companies can essentially change quantity without having any changes in price of inputs, wages and inputs of resources. So that's the very short run. That's why it's flat. So let's look at the very short run first. Let's say we're producing at this level. If the company wants to increase its production, it could just increase production to this level without affecting prices in the economy. But it can increase its own profits as long as it covers its variable costs. So like that, in the very short run, where the prices of inputs do not change and the prices of outputs don't change, then companies can make more money if they produce more, assuming that their variable costs are covered. The reasons for that are covered in microeconomics, but just see if you can remember that. In the short run, the sticky prices come into effect, and if a company wants to increase its level of production, here Q at the bottom, if it wants to increase its level of production, will do that assuming that prices in the economy increased, and in that case, some inputs go up, cost of inputs go up, but most things like wages and contracts for supplies might stay constant, and therefore the company will benefit by selling more at the higher price levels in the overall economy. And in the very long run, a company is already working at full capacity. We call this, this wasn't Q, I apologize. This was Y, and we call this potential output. At that level, or full employment, at that level, the company, regardless of changes in prices, will not be able to sustain higher levels of production, of output, regardless of changes in prices. Because in the very long run, prices of inputs, all of them, including wages and factors of production inputs, are also going to go up as well. So if prices of output go up, then in the long run, the cost of inputs will go up as well, and they'll adjust, and companies will still be producing the same levels as before. And another way of thinking about this long run, is that production, Y, is a function of capital and labor, and in the long run, capital is fixed and labor is fixed, and therefore, in the long run, the level of output is also fixed, and that's the other way of expressing full employment in the long run. Now that we kind of understand how we derive aggregate supply and aggregate demand from the previous video, and we understand that aggregate supply is a function of time as well, what companies can do when it's facing changes of input prices, well, then we can start thinking about how aggregate demand and aggregate supply interact with one another. So the interactions between aggregate demand and aggregate supply. Now, what is the objective of understanding this interaction? Because once we understand the interaction, we can understand and forecast growth, economic growth or contraction, which all business students and finance professionals need to know. We can make predictions on what would happen to inflation or deflation. And we have a better idea of what the sustainable growth path is. So think that sustainable growth path is like the growth that the country can experience without creating inflation or deflation. So, one more concept before we derive the interaction. Just understand, and I mentioned in the previous video, depending on where we are in the aggregate supply curve, we know that there's something called capacity utilization. Capacity utilization is like saying, I have a Ferrari, but I'm only driving in a 30 zone. The same way that I have a lot of machinery and a lot of employees, but they're not working at full capacity. That means my capacity is underutilized. And if I have the same machines and the same laborers, but they're working overtime and my machines are overheating, well, my capacity utilization is at its maximum. Okay? So, what are the determinants of aggregate demand in order to know what shifts it? Well, the first principal determinant is household wealth. When people feel wealthy, they usually buy more stuff, they spend more, and that will increase aggregate demand. The second determinant are expectations by households. So if you think that tomorrow the economy is going to grow and you're going to become wealthier because you have a bunch of stocks or you have real estate and the value of real estate is going up, the expectations of the future also affect how much you spend today. If you know you're going to be richer tomorrow, you might be more likely to go out and buy a new car. And the same goes for firms. Firms also make expectations about the future, and depending on those expectations, they might invest more. If they think they're going to sell more next year, they are more likely to buy more machinery. How much of the capacity of firms is being utilized, like we explained before. If I am under capacity, that means I have more machines and more people than I need, then I'm more likely maybe to downsize or more likely to increase output, knowing if the market can absorb it. Exchange rates in the market overall. If my exchange rate becomes expensive, people are less likely to buy my exports, and if my exchange rate becomes expensive, I am more likely to import stuff from abroad as foreign goods become cheaper. Global growth. As global economies grow, it is more likely that my economy will follow and I, as an economy, will buy more and produce more. And finally, fiscal policy. Fiscal policy was either government spending or taxes, and when the government spends more, the overall economy spends more, and as that happens, aggregate demand shifts to the right, it grows. And same thing with taxes. As taxes decrease, people are more likely to spend more, and therefore aggregate demand is also going to shift to the right. Or we can summarize this as the G minus T as the deficit, government deficit. And if the deficit grows, that means the government's spending more than its taxes, which is a stimulative policy pushing aggregate demand to the right. So what shifts aggregate supply, or determinants as I wrote it before, of aggregate supply were the cost of production, which I spent some time talking about. So the factors of production that go into my production, if those prices go up, I am likely to produce less because it became more expensive for me to produce and less profitable to do so. The wages, which is part of the cost of production. And what we need to think about is not only wages, but unit labor cost, which is the idea that it's true that maybe wages went up, but if the productivity of my labor also went up, then my unit labor cost might actually go down. So when we think about wages, we shouldn't be just afraid of wage growth. We should also look at productivity in combination with wage growth to know whether or not actual unit labor cost went up or down. This is the determinant of aggregate supply. The cost of resources and expectations, as before, but from the firm side. Taxes and subsidies on companies. Just recall the trade war between the US and China, how it affected international businesses and stock markets as a consequence. And exchange rates. The same logic as before, but from the perspective of suppliers. So let's put these things together. Aggregate supply, short run. Aggregate supply, long run. And aggregate demand, downward sloping. And prices and output on the Y and X axis. So let's look at what happens in equilibrium. In equilibrium, in the long run, we are at a point of full employment. This is where we're going to start, and this is the overall equilibrium price level in the long run. Let's say hypothetically, companies, the price of oil all over the world drops significantly, and this happened recently in early 2020. Well, if that happens, I think you guys should realize that most companies use oil in one form or another, whether to produce things or to consume them in transport. And if the cost of oil goes down, and then the cost of production for most companies go down, then it's likely for us to believe that the short run aggregate supply will shift to the right, incentivizing companies to produce more. And as we have this shift out, and if nothing changes in aggregate demand, assume for now, at the old price levels, companies, we moved away from the long run aggregate supply. In the short run, at the old price levels, the demand will be less than the aggregate supply. And in order to, this is excess supply, in order to find a new equilibrium, prices overall in the economy will drop to a new level and a higher level of output. But what will happen, P1, what will happen, think about this in steps, because this is what we call static. It's just one image in one part in time. So therefore, prices went down, companies produce more, but it is likely for us to see firms unable to sustain this increased level of production on the long run. And in that case, it is very likely for us to see a reversion back of the short run aggregate supply back to our initial levels, where output will fall back to full employment levels, and original price levels. And that is the important point, is that short-run deviations from long-run long-run full employment are rarely sustained over the long run. And that's why having an idea where full employment is and full output gives us an idea of what we call mean reversion, or reversion towards long-run growth. And finally, I will talk about this again, but this brings us to the idea that there is something called secular growth, which is a level of growth that can be sustained over the long run, and the business cycle. And business cycles are deviations from secular growth, and they're the ups and downs of the economy, trying to find this long-run equilibrium. We have put essentially everything together now. We have an understanding of all of the spending in a country, all of the income generated, what happens if there are differences between those in terms of inventory levels, disequilibriums in terms of goods and service markets, financial markets. We covered the liquidity preference for money. We put everything together. We got the ISLM curves, which created equilibriums, which allowed us to derive an aggregate demand curve. We then saw an aggregate supply curve, short run, long run, and how that equilibrium in the aggregate demand and aggregate supply curves indicates to us what price levels are commensurate with output levels. So we have this big picture now. Now we want to see what happens if there are changes to any one of these variables that we saw all along the way in the aggregate demand and aggregate supply curves, such that we can understand what situation we're in and what predictions we can make subsequent to that state, and what kind of investments we are likely to make given that environment. So we're going to cover learning outcomes J, K, and L for your reference. Now there are 4 types of states according to the aggregate demand and aggregate supply curves. Aggregate supply. The first state is the long run full employment level. In the long run, the economy should be where the aggregate demand intersects the long run aggregate supply. This is just a theoretical idea. At no point do we ever reach long run aggregate supply. It is just a movement, it's a dynamic movement towards that state. And we can deviate above long run aggregate supply or below. We can reach equilibrium levels at different points of full employment. And those are the 3 particular cases that we're going to cover now. A recessionary gap is the first of this kind. A recessionary gap occurs when aggregate demand falls below the long run intersection with aggregate demand, or below full employment. So as we see here, the aggregate demand falls below to the orange line aggregate demand prime. A new equilibrium emerges where P prime and Y prime are below the old price levels and below the full employment levels. That is what we call a recessionary gap. The things that may cause aggregate demand to shift to the left or fall are a fall in household wealth, pessimistic expectations by households and firms, which means that if I'm pessimistic about the future, I'm less likely to consume in the present. I have machinery and labor and capital that I'm not utilizing at full capacity. This central bank uses contractionary monetary policy at a bad time. We're increasing interest rates or decreasing money supply. A weakening of a foreign currency. So let's say we have a trade partner and that economy became, their currency devalues and they're less likely to buy our exports. That could be a cause. Or our currency got too strong, such that exports become expensive, so other trading partners do not buy from us. And we import more, and we saw that aggregate expenditure falls if imports increase because it's not produced within the country. And same thing with a global slowdown in economic activity. think about the coronavirus or SARS or things of the like, or trade wars. And finally, austerity measures by the government, where the government decides to decrease government spending or increase taxes such that they decrease the government deficit. The second state is one of a recession, not the second state. In the same state, what does that mean for us business students or finance professionals? Well, first of all, if we are in that state, there are three ways to return to the long run equilibrium. The first one is assuming that we are in a completely free market, no government intervention, no central bank. The lower prices imply that salaries are lower, and companies will eventually react to the lower prices of inputs and to the lower salaries by eventually increasing aggregate supply to the right and returning to the long run equilibrium. This is a slow and painful process and might take some time. The second step, or the second theory or a mode to approach this issue are the Keynesians. And the Keynesians, assuming that they react on time, very quickly, because usually there is a lag, they respond to a situation, so there's a lag. If they increase government spending or lower taxes, then you could assume that aggregate demand will increase, returning to long-run full employment. The monetarists believe that the government should intervene and the free market is a slow and painful process. Let the central bank intervene by lowering interest rates or increasing money supply, which would increase aggregate demand back to original levels. So some of the statistics that you might use to look at where we are and how we're improving or how things are changing, there's a lot, there are thousands of indicators, but things to start with: consumer sentiment indexes, factory orders, new housing starts, number of hours worked by the average employee, and changes in inventory levels by companies. So what is the implication? Well, first of all, if aggregate demand falls, we said prices fall and output falls, which means that you have more unemployment, lower corporate profits, higher commodity prices. Commodity prices will fall, because overall price levels fall. And credit demanded, so all people will not borrow, firms will not borrow to start new projects or buy new houses or buy new cars, things like that. And we're likely to see the central bank respond by lowering interest rates, because most most central banks will react to this and not leave the market to its own devices. So what kind of investment strategy would you be likely to use? Reduce your cyclical exposure, which means that do not invest in companies that are sensitive to business cycles. So housing is usually very cyclical. When the market increases, when the market grows, people feel wealthier, they are more likely to buy or upgrade homes. Reduce your commodity exposure, because prices of commodities, or all input prices and all prices across the board, are falling. Not a good time to be in commodities. And reduce your investments in speculative grade fixed income. So bonds from companies that are risky, because if they're risky and the economy is shrinking, that risk just became much, much higher. What you're supposed to do is you increase your exposure to defensive investments such as staples. Staples are types of goods and services that people use regardless of the state of the economy. Utilities are things like electricity and water as well, are non-cyclical, because regardless of the state of the economy, people still consume water and electricity almost to the same amounts. And increase your exposure to investment grade bonds, high quality debt. In addition to that, you might focus on long duration fixed income strategies, which means that you buy longer. For those in finance, you focus on duration of longer debt instruments, such that they are more sensitive to lowering interest rates, which we will predict given a recessionary gap. The second or the third condition, or the third situation we might find ourselves in is an inflationary gap where aggregate demand shifts to the right in this case. So now aggregate demand goes to the right, to the orange line, and price levels rise and output levels rise above full employment. So in this case, we have an inflationary gap, and the causes of that inflationary gap are like before, but the opposite. So increased household wealth, optimism, increased government deficits, so more government spending, lower taxes, and lower interest rates, again, poorly timed usually as well. So what could you see in this case? Well, if that happens, well, employees were already at full employment, so employees are probably going to be overworked, overtime, extra shifts. Machines are going to be heavily used. Likely, we're going to see excessive depreciation of capital in those cases, and those levels cannot be sustained over the long run. And eventually, things will have to go back down by employees demanding higher wages, by machinery needing to be upgraded or revamped, and we'll eventually see aggregate supply potentially shift to the left in order to go to, if that happens, if people ask for higher salaries and the machines have to be bought again, short run aggregate supply might shift to the left, causing further increases in prices, but a return to the full employment level of output. In that case, we are worse off than we were before, because despite having the same levels of output, we are at a generally higher level of price levels. But if that doesn't happen, it's possible to return aggregate demand back to the left such that we go back to the old level of aggregate demand. And the way that we can do that is by the Keynesians would decrease government spending or higher taxes, and the monetarists will likely increase taxes or decrease money supply. We would look at the same statistics as before, just moving in the opposite direction. And we would likely want to do the opposite investment strategies. So increase cyclical exposure, because we're expecting the short run profits to be above full employment levels. And we would increase commodity exposure because overall price levels are increasing. Increase speculative grade exposure, because speculative grade risky businesses that have fixed income, because they're riskier in general, offer higher yields, but because the economy is growing, are likely to be safe bets in the short term. And decrease your defensive exposures. And like before, we're going to focus on short duration fixed income strategies, which make us less sensitive to what we expect to happen, which is increasing of interest rates, which sees bond prices fall. So shorter durations are less sensitive to the fall in the price. And finally, the most dangerous of all economic environments is an environment of stagflation, where short-run aggregate supply falls to the left below long-run full employment, such that prices rise, we have inflation and falling output, which implies high unemployment. In an environment where prices are rising and unemployment is rising, the readjustment towards the long-run full employment level is extremely slow and very painful, as you need people to regain trust and rework capital in such a way that aggregate supply goes back to original levels. It is possible to fix and to remedy the situation, because we know aggregate supply is very slow to adjust in these circumstances. Usually this happens because, let's say, oil prices jump. And if oil prices jump, it affects almost all facets of the economy, of all industries, and costs go up across the board, and companies cannot afford and will afford to keep up all the production levels and actually see their profits being eaten away by the cost of inputs. So the only way to fix it in the short run is actually fiscal and monetary measures. So the Keynesians and the monetarists would be right to say that if it's timed properly and they're quick to react, increases in government spending, decreases in taxes, decreases in interest rates, and increases in money supply can potentially boost aggregate demand to the right and hopefully increase output to previous levels, but we would see a commensurate increase in price levels. Further, above and beyond the already inflated price levels. So this is a very dangerous environment that requires a lot of delicate maneuvering, and it's something that we fear, but all economies eventually go through. And finally, in the cases that we just saw, it was very clear as to what happened because only one, either the aggregate supply or the aggregate demand moved. But it's possible that both are moving continuously, and that's the reality. Remember, long-run aggregate supply is just some abstract idea, and aggregate demand and aggregate supply are very difficult to measure. So it's very possible that they're in their dynamism, they're moving together. And if that happens, we're not always clear as to what the effect on GDP and price levels is. So think if aggregate supply and aggregate demand both increase. So this is where we are. And aggregate supply goes to the right, increases, and aggregate demand goes to the right, it increases. Aggregate demand, aggregate supply. At the old price levels, in this example, the way I drew it, the price levels went up and the output definitely went up. But it's possible that aggregate supply goes up so much, for example, that the new equilibrium sees a lower price and a higher level of output. And that's why I say nuanced, because sometimes when the changes in aggregate supply and aggregate demand, we actually see, we can be sure of one thing but not sure of the other, because we're not sure of how much the curve shifted by. So in these cases, if aggregate supply increases and aggregate demand increases, we're sure that GDP will increase, but we're not sure what's going to happen to the price levels. And you can do this exercise with the other three to see what would happen. That's enough for this video. In the next video, we're going to start with economic growth. In this video, we're going to cover learning outcomes M, N, and O. So far we saw that the economy was principally described by GDP, and GDP can be determined by consumption levels, saving levels, investment levels, interest rates, exports, exchange rates, etc., etc. And we saw that, more importantly, that there was something called a sustainable level of production called full employment. And if we found an equilibrium that was not at full employment, then the economy was not stable. So how do we get full employment to grow? Because that's the only way to maintain growth. So that Y bar, that full employment that we saw, how do we get that long run aggregate supply to shift to the right and maintain growth in order to have equilibria that are sustainable, that are stable, that don't cause inflation or deflation or recessionary or inflationary gaps? In order to do that, we need to understand that there is such thing as an economy growing too fast, or those unsustainable equilibria. An economy grows too fast, we will suffer inflation. And inflation is not good for an economy, because imagine you have to continuously update prices and purchasing power degrades. This is obviously not an ideal situation. Furthermore, if we start producing too much, it is very possible that we can sustain environmental degradation. So think about an economy working too hard, factories overutilizing their machinery and oil and energy, and people are overworked, etc., etc. And it also requires that an economy saves a lot in order to have a lot of investment. And it's possible that we live in a society where saving rates are too high, such that consumption levels and standards of living are compromised. So with that in mind, we need to start thinking about GDP in terms of GDP per capita to understand standards of living, how much output or income per person, in order to find a sustainable growth rate. And this will help us understand what economies are doing better or worse than others in order for us to determine whether or not we should expand in those countries or allocate our investments to those countries. So the main questions are, what are the determinants of sustainable economic growth? Are these determinants stable? And how do we measure sustainable growth, and how do we forecast it? The main model that we use, the framework, is called the neoclassical growth model, or the Solow growth model. And the Solow growth model tells us that Y bar, full employment, is a function of labor and capital, so how many people in the economy are working and how many resources we have, times this factor A. And this factor A is a proxy for technology. So if one person has a shovel, well, how does the technology help us, or the knowledge of using that shovel help us produce more? And that's what TFP is. So the shovel is a capital, but A is the factor productivity, which helps us augment the utilization of that capital. And A is not something that we observe directly in the economy. It's something that we estimate. Now, not that long ago, before the neoclassical growth model, we were under the premise or the understanding of a Malthusian growth model. So Malthus, you might have seen in high school when he talked about the P's and the genetic codes, but Malthus was also famous for a population growth model that stated that labor is productive, but as populations grow, that marginal level of productivity decreases. And therefore, he predicted that eventually the population was going to get so big and can no longer increase production levels to sustain that level of population. And he predicted essentially an end of days, which is why economics actually got the name of dismal science, this gloomy science that predicted the end of the world. So what is the implications of the neoclassical growth model? Well, first of all, Malthus was wrong, because the economy still grew. We were able to maintain much higher levels of international population, global population. So the neoclassical model states that, or implies that, capital deepening, so having more K, is not sustainable. And less developed economies, because they have less capital, actually their marginal productivity of capital is higher than more developed countries, and therefore we should see a convergence of less developed economies towards more developed economies, this global convergence. And finally, the only way to sustain long-term growth is through technology. So how do we look at these factors of growth? Where are the sources of growth? Well, first of all, it's labor. The more labor we have, the more people can work. And however, we saw that the marginal productivity of labor is decreasing. So despite having more people, the additional person can only contribute so much and less than the person before him. And on average, what we're seeing is global working hours are actually decreasing. And the reason why they're decreasing is because, unions are working towards minimizing the work week, the working hours per week, maybe another day off, 4-day work weeks. Well, on average, we're seeing this global pattern. Human capital, perhaps the most important, is knowledge that humans gain through specific skills. So think about a software engineer learning Java. Well, that is an incredible source of growth, because human capital is sorry, I forgot the word, but it is such that if I use it, you can also use it. So think about a shovel like I was using before. If I use that shovel, you cannot use that shovel. But if I learn how to program and I developed an amazing code or an amazing software, you can also learn how to use that software and make something else with it. So human capital has something we call spillover effects. The same way that I know something in economics and I'm teaching you how to do that as well, or how to think about economics in those terms, that's a spillover effect. Capital, physical capital, so think about highways and machinery, well, that is measured through the level of investments in a country divided by the GDP, the total output in a country. And what we see are countries with higher investment levels also see higher growth levels. But may I remind you that even though we increase the level of capital, the additional unit of capital is less productive than the one before it. And finally, the only way that we can see all of those labor, human capital, and capital grow sustainably is through technology, this total factor productivity. And one proxy for that is research and development. How much is a country working towards improving technology? And finally, there are natural resources in a country, and those resources can be renewable or non-renewable. And obviously, we prefer renewable energies because they don't finish. So think about a forest. When you cut it down, you can replant it and it grows again. Whereas oil can deplete, and the country is left with no more resources. And finally, putting these things together, what we actually see, what really matters, is actually labor productivity. So if each person, L, how much can he produce, Y? And the more productive a nation is on average, the better off we are. And that is determined, Y over L is determined by total factor productivity and how much capital, human and physical, each person has.